We're right at the top of the hour, so we're gonna go ahead and get started. So I want to say thank you for coming out. It is so good to see all of your faces. We haven't done a live event in a few years now with COVID and everything, so just can't tell you how excited I am and the rest of the team here is just to be here with all of you here today. So thank you for being here. Thank you for taking the time out of your busy schedule to do this. We are being recorded today, so if you're joining us on the recording, I want to welcome you. Thank you for taking the time out of your busy schedule to be here as well. And I noticed we've got a few new faces, so I want to also welcome you guys who are new here today. Appreciate you taking the time. We got some more coming in, so go ahead and grab yourself a seat. Welcome, welcome. And so if you're new here today, my name is Eric Hagen. I'm a financial advisor. I'm also president of Capital Consulting Group, or CCG. CCG consists of myself, of financial advisors Dan Oshman. Where's Dan? Dan must be out in the hallway. We'll get him to wave later. Rana Grant. Rana, are you out here? There's Rana. Rana over here. Okay. We have our Chief Investment Officer, who you're going to hear from in a few minutes, Tom Fox. Tom's down front here. Many of you know him. It might be a new face to some of you as well. Then we have our client support, John Knutson, who joined us last fall. I think he's out in the hallway. You probably met him on the way in as well. And then, of course, most of you know Marilyn Westmark, who's been with us for a very long time. So not pictured, some extra help today. I got my girls here. So I've got Ava and Eden helping out. Hopefully they did a great job welcoming you guys in here today. So yeah, right? Love that. And then Dan's daughter, Kaylee, is also helping. I'm not sure if she's in here right now, but is she down front? Okay, so she would have welcomed you down front if you saw her. So that's the team. At the end of the day, we work for you. Our job is to work for you and only you. We're independent. We don't work for a large financial institution, for a bank. We are fully independent. We work for your best interest and only your best interest. We do two primary things: personal wealth planning. We can help you see your entire financial situation today and every day into the future. So if you're not taking advantage of that already, I encourage you to bring that up at our next review. And then we provide fiduciary investment management, or we essentially give your life savings the attention it deserves through our Smart Mix Portfolios solution. Smart Mix is our personalized process for developing a portfolio and an investment account that's as unique as you. And if you want to learn more about that after today, you can go to smartmixportfolios.com. We keep our finger on the pulse of what's going on in the markets, and there's a lot going on in the markets, and we love sharing what's going on out there in the economy and the markets. We do a monthly update like we're doing here today. Of course, this is live. Usually for a while we've been doing it online. So if you have not plugged into that, I strongly encourage you to plug into that. All the details are on the website. Again, we do it every single month. In your folders is a summary of today's presentation. On the back side of that is the dates for our next event. Again, we do it every single month. And so we encourage you to plug into those. There's a lot of information that is thrown around online and on TV, and we really want to provide that objective review of exactly what's going on in the economy and the markets. Every Monday morning, I also go live online. You can find it on the website. You can find it on Facebook or YouTube if you're there. I provide a short little recap of what happened in the markets the previous week. So I encourage you to plug into that. Again, an objective analysis of what's going on, much more short and sweet, 3 to 5 minutes tops. Thursdays, we have most Thursdays, we have our Capital Classroom Education Series. If you haven't seen that, you can go to the website as well. A couple of events coming up here. If you have any grandkids who are looking into financial aid, we've got 4 keys to cutting college costs and an inside look at qualifying for financial aid. Share it with your kids, grandkids if they need to. It's a great presentation on everything you need to know about that process. We also have Medicare events coming up. So 30 minutes on Medicare basics and managing healthcare expenses in retirement. That's more out in September. Looking all the way out into October, we have 4 keys to making a difference in a family caregiving challenge. So if you need to help a parent, if you need to help a spouse, putting together that plan for how to do that, it's a very in-depth presentation and message on that process. So we encourage you to plug into that. All of the events are recorded, so if you ever want to go back, we just wrapped up a couple of presentations on cybersecurity. Raise your hand if you've been hacked recently. Wow, wonderful. You probably were at those presentations. Yeah. Good job. All right. So how to hack-proof your smartphone, 1 hour to savvy cybersecurity. In June, we did a couple on legacy planning, not only how to pass on your valuables, but also your values. So a great message there. Again, the recordings are on the website. And let me be the first to invite all of you to the Capital Cruise Client Appreciation event. You guys are the first ones to be invited this year. We're so excited to be back on Lake Minnetonka, August 25th at 6 p.m. Mark your calendar. You can now go to the website and RSVP for that. We obviously had to take a break with COVID. Super excited to be back on that. I expect to see every single one of you on that cruise. It's going to be a very, very fun night. So we're looking forward to that. All right, so our agenda here this morning, we're going to hear from Tom. Tom, like I said, is our Chief Investment Officer. He does a lot of the work more behind the scenes, doing the due diligence, the research, the analysis, building portfolios, making stock recommendations, things like that. What he's going to do is he's going to review the first half of the year, what has happened in the economy and the markets. He's going to talk about the current positives that are out there, as well as the headwinds that we're dealing with, both the ones we are already dealing with and maybe some headwinds that we're watching out for. And then he's going to give an outlook for what he sees coming the second half of the year. He has been remarkably accurate in his outlooks in the past, so pay very close attention to his presentation, to his message here today. Tom has a very long history of doing this, over 35 years in the investment business, I think pushing 30 years as a chief investment officer. You can see his resume is very, very, very long. So I'm very excited to have you here, Tom. Thank you for being here. I'll turn it over to you.
I'll click for you.
Okay. Do I have a pointer?
You can do a red pointer.
Yeah, well, you can do it for me.
Yeah.
All right. Hello, everybody. What an exciting day to be here talking about investments. How many would envy having my job right now? But we do have some really good news. And the good news is I just heard from the golf course here that they are now allowing for you golfers to have, instead of give me putts at 3 feet, because of all the inflation, it's now 8 feet. So I may start up playing golf again. So anyway, very excited about talking to you about the markets and where we think things are going. But we're going to take a look back to what's happened to get a perspective, and then what maybe you may be thinking about as we go forward throughout this year. So the first half, what an exciting first half. So the S&P was down, the worst first half for the S&P 500 since the Nixon era. I mean, remember Watergate. There's a great show on regarding that, I think Gaslit or whatever it is. But we've had a terrible first half. The NASDAQ fell nearly 30%. How many think that's a pretty big drop? So we have stocks, the broad ones, and then we have the tech-oriented NASDAQ down over nearly 30%. And then our safety for historically has been bonds. That's the buffer, the 60-40 portfolio, which normally puts a cushion on the downside. But bonds, after 4 decades of good returns, ends up down over 10%, 10.4%. So there seems to be, in the first half, no place to hide. And we're going to be talking about that. There were a few slivers of opportunities, and we captured some of those, but it's been a really tough first half. So how are you feeling about the first half?
Bad.
Bad. Okay. Well, the good news is you don't stay in the first half. We have a second half. And so we're going to look at Eric or whoever's. Okay. So let's look at the asset classes. And you can see all the red up there. The S&P is down 20%. Dow is down 15, 29. You can see all the numbers going down. There really wasn't any place to hide except for the U.S. dollar, which right now is parity with the euro, and then West Texas Intermediate crude. So oil's up and the dollar's up. That's it. How many that's where you put all your money is in crude oil or the U.S. dollar. So really there wasn't any place to hide, even copper. But so here's the traditional 60-40 portfolio is down 16.54% or whatever it is. And you can see how difficult of a market the first half has been. Now, if you look at the U.S. sector side and you look at the first half sector performance, there was only one sector that had a positive return out of all these sectors, and that was energy. Of course, that's related to the crude oil pricing. And so that was it. Utilities did a little better than most of them, or consumer staples. And then we have discretionary and sectors that were really way down. You can see the S&P in the middle. So in terms of sector rotation, where could I go in the stock market the fast? There wasn't a lot of places you could go to maintain diversification. And obviously, we want to have diversification in your portfolio. So what am I saying? There was no place to go in the first half. Now you can see this bear market touched down at minus 21.8. You can see on a historical basis how the magnitude of that, and you can see that there have been a few years where we had a similar bear market. Back in the 48, 57, and 66, we had a downdraft into the bear market bottom, very similar to where we touched today. And you got to remember that we've been in the correction much longer than we have been in the bear market. A correction is minus 10 to minus 19.9999, and then a bear market's 20% or more. And so we've only spent actually a few days in the bear market. In fact, this morning after this major print of the CPI, which came in at 9.1 year over year for June, the markets went down, and they probably went over the line into bear market, but now they've recovered. We'll see where they end up for the day. Because it's an interesting, because initially when they got the print this morning, I wish I would have had that data yesterday or a few days ago preparing this, but the print was higher than we've seen even in the last few months. So now the question is whether or not inflation is peaking. Was that the highest print that we'll see, and is it turning around? And I will give you some information on that. You can see how fast this last bear market previous to that during the pandemic, the bear market lasted 33 days. So it was very short, unusually short. Now we're 161 days into since we went over the line. And again, we've been mostly in the correction area, but we have touched into the bear market. Now this chart is something I want you to really focus in on. The green is the recovery from bear markets. So the average return is minus 33 for a bear market. But what happens after bear markets?
Bull market.
Bull market, 167%. So this is something to keep in mind, because it's really painful in the bear market. And typically, an investor that's led by their emotions, and we're going to talk about emotionalism, but emotions will want you to sell when things are really bad. And then when things are really starting to get good, then you want to buy. And usually you've missed most of the market. But I want you to keep a historical perspective that markets go up 2/3 of the time. Only 1/3 of the time do they go down. So I'm an optimist. My glass is half full. Maybe you see that in some of my writings. But you can see we're here in this little spot, and I'm expecting another green moment from a recovery into a bull market. So I want to just get this right off the table. In our forecast, where were we wrong, like the funds? So we said that we would not go into a bear market, and it did. It went over the line into minus 21.8, so we underestimated the downside. And mainly we underestimated because of the impact of the Russia-Ukraine war, which is a geopolitical event which are very difficult to forecast. Also, we said that the 10-year yield will rise to 2.5, and that was much higher than most market strategists back then, but it actually almost touched 3.5%. And then our one strategy that's a high growth strategy We thought it would rally. It did not. So that's what we got wrong. I want to get that quickly off the table and move into where we were right. So we did say last year, the end of December, that it was going to be a tough first half. We did say that we were going to go into a correction in the first half. And we call this the year of transition, where the first half was going to be very difficult, but the second half would be much better. And so we did get that right in terms that we did go into correction. We said it would be turbulent. How many think it's been turbulent? It's been very turbulent. Now, we said this back in December and kept saying it as we went through the year. Another thing that we did that was really beneficial to your portfolios, because many of you have a stock component and then you'll have a fixed alt component. And we made some really good decisions by getting out of bonds back in 21, early 21, and we went to alternatives. So we've actually got a positive return in the fixed alt, which is not too many people can say that. So that's the cushion. Remember, bonds are down over 10% for the year. Our fixed alt was up slightly. So that's a huge variance, over 1,000 basis points variance. So we made a really good decision on that. And we also made some really good decisions considering what we had to work with only one sector up, and that was energy. But we did diminish the downside a little bit. And 7 out of 8 of our strategies actually no bear market. The only one that was that thematic growth, the 7 did not go into bear market. Our fixed alt did not, and several other strategies. So 7 of our 8 smart mix strategies outperformed the respective benchmark that we would bench against. So here it is. The top part is just showing the S&P, the total market, and then we have the 60-40, which is the S&P bar cap, and then we have the bar cap itself down 10-4. And here's our strategy returns, a recovery portfolio. Those are things that got beat up in the pandemic. That actually had a positive return the first half. The fixed alt up 0.5% versus minus 10.4 for the bonds. And then we had super dividend, which is a strategy that focuses on higher dividend, 5% plus. That had just barely negative. In fact, it was positive most of this first half. And then our tactical sector is minus 13, wide moat, which is our probably most popular Warren Buffett core strategy, was down 15.3, and durable dividend 16.3, and then our tactical style 16.4. And this was our one loser was a thematic growth. Now that component was up 60% a few years ago. So it's a high growth, and right now nobody is rewarding or wants to be in high growth. So that's only strategy that suffered. But I know this, oh boy, you got minus 13 or minus 15. That makes me really excited. You did better than minus 20. But for our business, that is really good. So we're kind of proud of that, even though nobody feels good about it. But we think the returns were really good overall. Okay, so I'm going to talk now about the wall of worry. Markets climb a wall of worry, and so we have plenty of worry. And the first thing is that there's a high risk of the Fed over tightening. And now with the new print of 9.1 on the inflation year over year, there's now speculation that they're not going to do 75 basis points. They're going to do 1% interest rate hike in this next meeting. We'll see what happens. You can see that the markets initially went down this morning when it was announced, and then they started to come up, and I don't know where they are right now. They actually went positive, and which tells me that that's old news. The print of 9.1 may have been the peak. We're going to look at some data on that. And also the valuations to where we reached in the bear market have not come down based on historical valuation drops. The PE ratio didn't quite reach where you normally would see inside of a bear market or recession. So we haven't seen the low prices, even though they're lower, but we haven't seen the kind of drop we would normally see in a bear market. So that's worrisome. And then we have corporate earnings slowing down, although Pepsi just came out with theirs, and it was better than expected. So we'll see how it all shakes out over the next several weeks on the terms of corporate earnings. But it is slowing. We expect it to slow. We're starting to see the economy slow, and the Russia war and Ukraine war, there's no end in sight. And that's something you can't forecast because it's one of these geopolitical events, unless somebody can tell me what Putin's thinking. And I don't think anybody here, unless you know him, I don't. Since World War II, inflation above 5% has preceded a recession every time. So these are just some of the worrisome things. And then 10 of the past 13 recessions have followed a Fed tightening cycle. That's a high percentage. And then we have every time oil prices have doubled, we go into a recession. So there's a lot to worry about. But remember that the equity markets will discount the future. And so when we're in a recession, by the time the academics, economists and academics begin to say, hey, we're in a recession, we're already coming out of the recession by the time we hear we're in a recession typically. And when you're in a difficult time, the markets discount the future out over a year and a half, which means that when you're in a recession, about halfway through a recession, the market's already starting to move up because it's already discounting better times in a year and a half out. That's why it's really difficult to make decisions around if we're going to have a recession or not. And we're going to look at some more data on that. So we have very smart people that are saying different things. I would say the majority are in the recession camp, tough times camp. But there are some out there, Tom Lee's another one at Fundstrat, and others that are saying that we're not going to go into recession this year. And I'll tell you what our odds are of recession, but we are going to come up with a scenario called soft or soft. And we'll look at that in just a few minutes. But the point is, there are smart people that are on either side. Now, I was just looking at a survey by people that do what I do. These are chief investment officers, strategists around the U.S. And here's what they say. They're confused, they're frustrated, and they can't seem to get a firm direction on the investments because we're in unprecedented times. So even the smartest people have some disagreement on what's going to happen because we're in abnormal times. And so that they can't get a firm view. They can't, this is what we think is going to happen. So I'm not going to be overly dogmatic in my views because even the smartest investors in the world aren't sure what's going to happen. But I do know this will be short-lived and we'll come out the other side. Okay, so what are some positives? And I have a pretty good sized list. Positives, there's that inflation is starting to roll over. We're going to look at some numbers, even though we had a 9.1% print this morning. Hello? Okay, so I have a good friend here. He normally keeps his phone on, so it's not you. I'm glad, Chuck Porta, it's not you. All right, so much of the bad news is already in stock prices, which means that the market has already come down with a 78% probability of a recession happening. So a lot of the bad news is already in where we are in the stock price. Unemployment is very low. This is one of the keys. We're at a 40-year low just about. In fact, the employment print that just came out was better than expected. There are more jobs and people that are unemployed, so that we have a labor shortage. And that is not typical of a recession. And we'll talk more about that. Valuations are attractive, and we believe it's going to be stock selection going forward. We think indexing, owning the broad market is not the place to be because there's going to be pockets of opportunities. Over the long term, indexing has done very well, but there are seasons where individual stock selection makes the difference. And we're working hard on that for you. So here's another positive, that any less bad news than it's already out there, or even maybe a slice of good news, it will amplify the stock market to the upside. Because everybody's so bearish that if you get any less bad news or even some good news, the markets are going to go up faster than what you expect. Okay, so and by the way, the economy is still expanding. We haven't gone, if you look at all the PMI data, it still shows it's slowing, but it is still expanding. And households and corporations have plenty of money. I was just looking at this, that U.S. households held $3 trillion more in their checking account than they did prior to the pandemic. Lots of money is in the hands of individuals. Why? Because they weren't spending it because everybody was locked down during the pandemic. And so everybody kind of went into a savings mode. Well, corporations are healthy in terms of finances, but so are individuals. So that you have that 2/3 of the economy are consumers. So they have some money to spend to help them through, even if we do slow down or go into recession. So corporations and savings are looking good. The service sector may carry the day. Mostly the economy has been driven by goods, not services, but there's been a shift. People are finally saying, hey, I want to get out of my house. I want to go travel to Arizona or Florida or wherever. I want to go do something, and I want to go to that restaurant. I want to do this. So it's the service sector may carry the day. And here's another one, because we do have a kind of Warren Buffett strategy called wide moat. Warren Buffett, who's one of the best, most seasoned investors in the world, he's buying right now. Why is he doing that? Because this is the time to buy. You buy on bad news. Your emotions say you're crazy. But the best time to put your money to work is in a bear market or deep recession. So we'll see what happens here. Okay. Now, so I said that 78% probability is already in the stock price, the stock market, but the credit markets are saying something different. Quality credit is only 47% probability. High yield saying 34%, and the 5-year U.S. Treasury really 18% probability of a recession. So there's a little disconnect between what the stock market is saying and some of the credit markets. Okay, this is radical, so close your eyes. But we may be heading into a deflationary trend. And I'll show you some charts on that. This is pretty counter to a lot of people. This is some commodity prices, copper and oil. It's come down. Even now we're below $100 in the oil price. I think it's around $96. So we've gone below 100. This kind of shows we're still above. But copper prices have been coming down, and so is oil. Now you won't see that at the gas station yet. There's a delay. Everybody's got to make their money while they can. It's like when rates are going up, the banks will raise your rate right away. When rates are going down, they're very slow to lower the rate. So somebody's making money. So you can see we were within $5 of the pre-Russian Ukraine war in terms of oil prices. Now that's not in the gas prices yet, or transportation, but we're going to see that, and as long as we stay below 100, this is pretty good news. So that's deflationary, and you can see the gas has not come down much, 4.3% at the pump, so it's still up very high. But look at the futures; they dropped 24%. So the contract for fuel has dropped significantly, but we don't see it yet because it's a leading indicator. So we'll see what happens, but I'm expecting prices to come down. Here's another one. This is looking at the 1-year inflation outlook. It went from 5.6 to 4. So right now, when you take a look at the 1-year outlook for inflation, it's expected to come down. That's probably why you saw the market go down early this morning and then come back up. So then we have the implied Fed funds rate, and now that was prior to today. because it went down from 3.78. That's where they'll end up, or the Fed rate will go to 3.3. That may be bouncing around today because now there's fees said earlier. So that's a kind of older chart because this morning we had brand new news. So we'll see if the Fed responds to a kind of backward-looking inflation number, or are they looking at some of the components and where they're going, and they're starting to decline slowly. Okay, the economy is still expanding. This is the June flash PMIs. You can see the red is 50. If you're above that line, that means the economy is still growing. If it drops below that, that means it's not. So we're barely, you can see it got softer, it's been coming down, but we're still kind of an edge over the 50 mark. So it is still expanding at this point. That could change. We could go into a recession. We'll talk more about that. Now, this is an interesting chart because it shows the price of the stock market, and it shows valuations. You can see valuations have gotten, obviously would follow the prices coming down in stocks, so stocks are getting cheaper. However, the top line is showing that earnings are still doing okay. And we just saw that with Pepsi. I think we're going to have decent earnings overall. There'll be pockets that won't do well. But this earnings season we're in now, we're just at the beginning, I think it will end up being fairly decent. So that's a good sign for in terms of a recession or where we're going to be going. All right, and so here's a big disconnect. This is consumer sentiment, how you all feel. That's the green line. So all of you probably are really depressed and you're down here. But what are you doing? You're spending. So there's a real disconnect between how you feel things are going and then what you're actually doing with your pocketbook. So that's pretty good news for the stock market. Here's the big one, unemployment. We're at a close to a 40-year low. In fact, the number just came out. It's holding 3.6. There's plenty of jobs. This is not typical of a deep recession or a big recession coming. So this is some of those. We have money in the hands of consumers, corporations, and we have low unemployment. So this number would suggest that if we do slip into a recession, it's going to be a very soft recession. So here's the Fed's balancing act. This is what they're trying to delicately keep us out of going into a full-blown recession, but get inflation to come down. So you can see that if they tighten too much, they're going to cause a recession. That'd be better for bonds because they're going to have to eventually lower the rates. And if they tighten too little, then you have inflation, and that seems to be better for stocks. And then if it strikes a balance, they actually somehow pull off the impossible soft landing. That has an edge to stocks. So that's 2 to 1. So I'm favorable towards stocks. Okay, so what's our outlook for the rest of the year? We're expecting inflation will trend lower. We didn't see that in the June report, but we do before the year end. We're going to start coming down. We think we're going to move into a deflationary period. We're going to see commodity prices fall. They're already starting. Corporate earnings and revenues will remain decent. There'll be pockets of good and bad, but overall, in aggregate, we think they're going to do well. The consumer will keep spending because they got the money. And our outlook for the economy is either soft or soft. Nobody's heard that, I don't think, on any of the channels. So that's originated here. Soft or soft. Soft landing or soft recession. We don't have what's necessary for a deep recession. Midterm election, that's interesting. If you look historically, during the midterm political cycle, the first half, the market averages about 1%. In the second half of the year of the midterm, it averages 13%. So there seems to be historically kind of a weird seasonality in the midterm that you have a better second half. So that's at play. And so the Russia-Ukraine war, we're saying that by the year end, some form of settlement will happen. Now, we could be dead wrong on that. but that's what we're thinking. And by the way, if it does settle, there's going to be a lot of movement, especially in energy stocks. We're preparing for that. And then you have our forecast. I used to give a number. In fact, were we right on a few years in a row?
Within like 25 points.
Within 25 points, forecasting the end, but I cannot forecast this year. There's too many things that are up in the air. So I'm just going to say this, it's going to be higher. All right. And remember, we've been saying it's been a year of transition. Terrible first half, correction, and it will be a better. And how many are all invested in cryptocurrencies? Ouch. We don't recommend that, but you can maybe put something in there. It's very, what a cryptocurrency price is, what we all think it is in aggregate. I think the price should be here, we all think the same thing, and that's where it is. It's also almost all traders, and it's what they all think in aggregate what it should be worth. There's no utility. It's really nothing. In fact, they don't use cryptocurrency to buy and sell typically. Maybe 3% or 4% is used to actually buy and sell things. It's all trading. You can see it was the worst month ever, -40. We have cryptocurrency companies that went bankrupt, and I guess Eric just told me there's two founders that were of one of those companies, and they're nowhere to be found. So they're who knows where they are. So yeah, it was a terrible month. And the hope of cryptocurrency would be another asset class, and that it would have a different return pattern than the stock market. In other words, they may ebb and flow to smooth out the overall returns. That's what we all try to do. But they haven't. When the stock market's down, cryptocurrency's down more. So there hasn't been this diversification benefit in cryptocurrency. So at your own risk or peril. So what are the opportunities we see coming forward? Individual stocks going forward instead of indexing. And we've been picking up some very good tech stocks, some software companies that don't have to deal with supply chains at great prices, good earnings, low valuation, they're oversold. So we think anything we go into, we're holding for at least 12 months to 24 months. So we're looking down the road. But we've got some really good tech stocks that I think will do well. Not that there's not more downside, there could be, but we like the risk reward on those. And again, if Ukraine resolves, energy stocks will plummet. So we're going to reduce our positioning in oils or energy companies. Some of our strategies have more energy, and then we come out of those. And I think the best way to do that is on another rally, come out on a rally, because it will happen at some point. Or this could be a 4-year war or not, I don't know. But so we're going to reduce our energy exposure, especially in some of our strategies. And then also, if inflation starts showing signs of coming down or yields spike a lot and go way up, we will probably move money out of the alternatives, which have done so well during this period, and move back into bonds. So we are not there yet. We're watching that. So we may move out of some of our big winners in the alternatives and go into back to bonds. So I'm going to end this with 3 quotes from some really good investors. Almost all the great investors I know are unemotional. How many unemotional people do we have here? Unemotionalism, I'm not even sure that's a word, is one of the most important criteria for being a successful investor. We don't want to make decisions on emotion. We want a weight of evidence. We want quantitative analysis. We want to make all of our decisions not based on feelings. Shelby Davis, you make most of your money in a bear market. You just don't realize it at the time. That means you stay invested, or you even put more money into stocks in the bear market. That's where you make your money. And of course, Warren Buffett had to throw something. The best chance to deploy capital is when things are going down. So is this a time, in my opinion, to take money off the table? No. it's the time to even consider putting more money into stocks. And when all your emotions say something different. All right.
But does that mean you should take your cash and put it all in the market right now?
No.
No.
You have a solid financial advisor here.
What it means is that if you want to talk about your mix, so remember, we call our portfolio solutions Smart Mix. What makes it smart is that we will take the time to customize your mix to you and your situation. And it could be different amongst your different accounts. So if you want to meet, re-review your mix, what it looks like, how it's been doing, talk about any potential changes to your mix, look at the performance of your mix, look at the risk-reward characteristics of your mix. Go to the website. We have a 24/7 calendar tool on there to schedule a meeting. Call Marilyn at the office. She'll set up a time on the calendar, whether it's with me or Rana or Dan. That's what this means. So don't take from this that it's time to put all of your cash you've been tucking away under the mattress or in the bank into the market. What it means is that maybe it's time to have a discussion about changing the mix or a discussion about your risk-reward characteristics, et cetera. Does that make sense?
Mm-hmm.
Wonderful. With that,
Are we having Q&A?
I love to put this guy to the
Okay, I got to go.
questions. We'd love to take it. Yes, Mary.
You bring up low inflation, or excuse me, you bring up low unemployment is a strength for the economy. However, I see it as a very big danger as employers are having to pay a fortune, even to pay people working for McDonald's. And all of that has to come back to the consumer and the products. That's my one comment. My second thing is, why am I only getting 1% return on my savings account when inflation is now at 9%?
Well, the answer to the second question first is because your bank or wherever you have the money, they have it in very short-term instruments, and they should be paying you more. It should be rising. Hasn't gone up very little. Because the one reason is they make profit by being slow to raise your rate. And so it's just the way the financial system works. The first question, employment inflation is rising. And that is an issue, but we don't think it's the weight of that is larger than being employed for the economy. I mean, it's going to cause some problems, but it's not the major inflationary impact right now.
Great questions. Thank you.
Thank you. That's a good one.
I saw Herman. Oh, Ann.
Yeah. Cryptocurrency is such a mystery to me. I've heard that they actually make it into sort of energy. Is that true?
To a what?
That they use a lot of energy to actually make the currency itself, or is it just a fantasy?
What is crypto?
So what is crypto?
Do they use a lot of energy?
Do you have a few hours that we'll talk about it? Cryptocurrency is a way to have a store of value without any institution or government involved. And it's spread out, all the pricing and any transaction is spread out all over among thousands of different computers. And then whenever a transaction is made, all the computers have to agree on it. So it's a way to avoid institutional or governmental oversight, and it's a way to trade money. The problem with cryptocurrency is it doesn't hold its value all the time. Now, there are some stable coins to the US dollar. They've so far been able to hold up and keep their par, close to their par. But the rest is mostly speculation, and most everybody in cryptocurrency are traders trying to outdo one or another. And you know, I personally would not get involved. No. So now there's someday that may change, but a stable coin, and then there was even a stable coin that was algo driven, where they try to keep it pegged to the US dollar, but the algos broke down and the thing crashed. Luma, it went from $30, $40 to a few cents. And And so it's early in its infancy in terms of technology, but it has some real benefits of security of the information of buys and sells and pricing that makes it have an advantage. So there are some good advantages to it, but it's just still early. If Bitcoin goes to 7,500, maybe put some money into it.
It's difficult to pick and choose the stocks you guys have got a job to, but the one thing is the energy sector that seems to evolve to much way up and now it's coming down. So it's coming down, you guys gonna make any changes to whatever energy stocks and what rate?
Yes, it's on our radar list. I mean, it came down so fast, recently, but now it's kind of holding and kind of edging up a little bit, kind of bouncing around. We're expecting another rally, and it might come from the earnings when they announce the revenue and earnings. I think that may be a real positive, but we'll see. I do want to reduce the exposure, especially in some of the higher weighting towards energy portfolios. But it's on my mind all the time.
Yes, I've never heard the term thematic investment. Could you explain that?
Yeah, thematic growth is investing in companies that are disruptive technologies. That it would be like you used to use a travel agent, and now everybody does it on Orbitz or Kayak or wherever you go for your travel needs. You can do it right from your home on your PC. That was a disruptive for the travel business. So these are things like robotics, AI software, genomics, biotechnology, and different things that have the ability to become big earners and big revenue and take bigger share of older line kind of ways of doing things. Because technology is moving so fast, and it used to take forever for a company to adopt into society. Now today, when the iPad came out, it was like a J curve. It was immediately adopted, where it took years for the telephone, years for the refrigerator to adopt into a society. Today, things adopt so quickly, so they can become profitable very quickly. But these are disruptive, high-end technology companies in all kinds of areas and fields.
Thank you. Can you help me understand? I'm trying to figure out, okay, a lot of people have a lot of cash right now, and because they've been saving through COVID, whatever, but they've got the buildup of cash. Okay, what's the impact of that cash on the recession cycle? You know what I mean?
Mm-hmm.
It's like, was there cash in previous cycles?
Not this level.
Okay, so that's what I'm getting at.
Yeah, so what it means is that you can go out and do things or spend money, buy the furniture, or do some other things because you have the money sitting there. Other times it was not so much, so you couldn't do that, make that decision. So it does, whether people are going to start spending more, they have the ability. And we don't know exactly the behavior of the consumer, how it's going to shake out, but at least they have the dry powder to go to.
So does that help us get back to a bull market then?
I think so. I think what it means is the economy probably won't be as deep. I mean, the recession won't, if we do go into recession, it's not going to be as deep. That's why I'm soft, because of that spending ability that's still in the consumer hands. I mean, it's high. We have a lot of money in the checking accounts and other things. So you have that flexibility. And even if we do go into recession, you have money to keep you going and keep doing things. So it's a little different than other recessions. So that's why, again, that I'm expecting either a soft landing or a soft, not a hard, but a soft recession if we do go into one. So I think it's bullish, yeah.
You talked about disruptive technologies, and I'm curious if does that include these electric cars with all the precious metals they need? the lithium and manganese and.
Yeah, actually, one of our holdings is lithium. So yeah, there's a huge movement towards EV, and there's some startup companies, and it's the future. So that's where things are going. Tesla was the trailblazer, pioneer, but there are many more coming. So that is definitely an area of disruptive technology. And we have some positioning in that. And we have some other opportunities we're not in right now that it's in our universe to buy for more EV oriented.
Yeah.
I mean, it's happening. All the car companies are moving towards EV. So it's a tidal wave coming through.
I saw another hand over there.
Anybody else? Well, thank you for the opportunity to speak and share today. And I got to go catch a bus.
Well, again, thank you, Tom, very much. Appreciate that. And thank you, all of you, for coming out here today. I hope that was of value. We are going to stick around. Marilyn has prepared a wonderful lunch for us. I think what we should do is so lunch is all set up, ready to go grab it in the hallway here where you came in. I think what we should probably do is go by table. So we'll do that. We'll get the music going. We'll stick around. Tom and I will be around. If you guys have any other questions or anything, we'll be around for that. So again, thank you guys all for coming out. And remember, make sure you RSVP for that boat cruise. We'd love to have you all out next month, okay? All right. Thanks, you guys.